Bank of Japan money market data just confirmed what traders suspected, a massive 4.68 trillion yen liquidity shortfall, signaling a fresh round of currency intervention. This roughly $30 billion move occurred during thin holiday liquidity, catching many off guard. Today, we break down the data from the Ministry of Finance and the Bank of Japan to see how this caps US dollar to Japanese yen upside and shifts the macro landscape for the Nikkei. Heading into this data release, US dollar to Japanese yen had briefly pierced the 160 level during the Golden Week holidays, a psychological and technical threshold that triggered immediate alarm bells in Tokyo. Positioning was extremely stretched, with leveraged funds holding near-record yen shorts to fund carry trades into higher-yielding assets. The market was operating in a vacuum of official confirmation, pricing in a high intervention premium but lacking the hard numbers to verify the scale of the Ministry of Finance's counterattack. Resistance was firmly established at 158.00, while traders closely monitored the 155.00 support level for signs of official bids. The atmosphere was one of high tension, with the Bank of Japan, led by Governor Kazuo Ueda, maintaining a cautious stance on interest rate hikes despite the currency's rapid depreciation. The hard data now reveals the mechanics of the defense. The Bank of Japan's current account balance projections showed a gap of 4.68 trillion yen compared to private sector estimates. In the world of Tokyo macro, this delta is the smoking gun for foreign exchange intervention. By analyzing the daily flow, we see sequential actions, an estimated 3.2 trillion yen on Thursday followed by another 3.5 trillion on Friday as the yen weakened past the 160 mark. This brings the total estimated spend by the Ministry of Finance to approximately $65 billion over the recent period. This isn't just a one-off smoothing operation, it is a sustained campaign to punish speculators and reset the volatility surface. For traders, this means the Ministry of Finance is actively utilizing the Bank of Japan's plumbing to drain liquidity and force a yen short squeeze during periods when global desks are thinly staffed. Reaction from the street was swift. Michael Brown, a senior research strategist at Pepperstone, noted that the BOJ data points to fresh intervention days that align perfectly with recent price gaps. Macro analysts at Flashfeed emphasized that these sequential flows signal an escalating defense by the Ministry of Finance, heightening the risk of a broader yen carry trade unwind. Meanwhile, analysts from Forex Analytics pointed out that while the total intervention has hit $65 billion, the Japanese yen has only gained about 3% since last week, suggesting mixed success in reversing the trend. These voices reflect a growing consensus. Tokyo is willing to spend big, but without a fundamental shift in the interest rate differential between the Federal Reserve and the Bank of Japan, these interventions may only provide temporary relief for the currency. How does this move through the markets? First, the direct cap on US dollar to Japanese yen pressures yen shorts, forcing a reduction in carry trade exposure. This volatility spills into the Nikkei 225, particularly impacting large-cap exporters like Toyota and Tokyo Electron, which benefit from a weaker yen. As the Ministry of Finance sells U.S. Treasuries to fund these yen buys, we see ripples in global bond yields. Locally, the intervention drains yen liquidity from the banking system, which can tighten domestic money market conditions. For equity traders, this often leads to a rotation out of export-heavy sectors and into domestic-oriented plays or bank stocks that might benefit if the Bank of Japan is eventually forced to hike rates to support the currency. The transmission is clear. Higher currency volatility equals a higher risk premium for all Japan-linked assets. The Japanese financial press, led by the Nikkei, is focusing on the strategic timing of these moves. Local reporters are highlighting that the authorities specifically chose the Golden Week holiday period to maximize the impact of their yen buying when liquidity was lowest. There is also significant coverage of Sony Group's recent earnings, which reported record profits driven by the PlayStation 5 and a boom in memory prices. The local narrative is bifurcated. While the Ministry of Finance fights the currency war, Japanese corporate giants are still harvesting the benefits of a historical yen weakness. However, The press is also reporting an increasing sense of urgency within the Prime Minister's office, as the rising cost of imported energy and food begins to weigh on consumer sentiment and political approval ratings, putting pressure on Governor Ueda to act. Positioning data suggests a significant shift is underway. Leveraged accounts are beginning to trim their yen shorts as the intervention tax becomes too expensive to ignore. Real money investors and large institutions like the Government Pension Investment Fund are closely watching these levels for rebalancing opportunities. We are seeing early signs of repatriation flows, where Japanese firms bring overseas profits back home, potentially providing a natural tailwind for the yen. However, retail margin traders in Japan, known collectively as Mrs. Watanabe, remain a wild card. Historically, they have been quick to buy the dip in US dollar to Japanese yen, providing a floor for the pair even in the face of official intervention. The current data hints that while institutional shorts are being squeezed, the structural demand for dollars remains robust among domestic retail investors and energy importers. For the sessions ahead, several key markers are on the radar. Technically, 154.50 is the critical support level. A break below this could accelerate the yen's recovery toward 150. On the upside, the daily cloud resistance between 156.25 and 158.60 remains the zone to fade. Keep a close eye on any unscheduled speeches from Vice Minister of Finance for International Affairs Masato Kanda, the man who directs these interventions. Beyond the currency, watch the 10-year JGB yields for any signs that the Bank of Japan is allowing rates to drift higher in a stealth tightening move. Finally, the upcoming U.S. inflation data will be the ultimate arbiter. If U.S. yields move significantly higher, even a $65 billion war chest from the Ministry of Finance may not be enough to hold the line at 160. In our hawkish scenario, the Bank of Japan delivers a surprise rate hike in June to align with the Ministry of Finance's currency defense, sending US dollar to Japanese yen toward 150 and cooling the Nikkei. The trigger would be sustained inflation above target and a failing yen defense. In the dovish or baseline scenario, the Ministry of Finance continues to intervene intermittently, keeping the pair in a volatile range between 154 and 158, while waiting for US data to soften. This would lead to a choppy, range-bound market for equities. In a bearish scenario for the yen, the intervention capacity is questioned by the market, and a relentless climb in US Treasury yields forces a retest of 160. Traders should remain nimble, as the Ministry of Finance has demonstrated they will strike when least expected, making fading US dollar to Japanese yen rallies the current consensus trade, provided 160 remains the hard ceiling. To recap, BOJ data confirms a massive 4.68 trillion yen intervention, bringing the total defense fund to roughly $65 billion. US dollar to Japanese yen upside is effectively capped at 160 for now, but the 155 support level is the immediate battleground. Watch the interest rate gap and official rhetoric for the next move. If you found this macro brief useful, subscribe to Tokyo Macro Daily for your morning trading floor update. We will see you at the next open.